Hello, this is Brian Resney, President of Resney Wealth Management, bringing an important update about the economy and the investment markets. Well, as you know, first quarter is officially done, off to a decent start for 2023. Do not get complacent, though, as I always say. We're always worried about something. We're always looking at everything. And I just want to make sure clients are not complacent, meaning volatility is not gone. It'll never be gone. It'll be here forever, meaning we're going to steer step up and we'll steer step down occasionally. It's the nature of investing. One of the interesting things I want to talk about, though, is oil. As you all know, we own oil in our portfolio and have for the last couple of years, and has done quite well. Year to date, it's off slightly from its high. Not a major concern. But what's interesting, as you probably all heard the other day, that Saudi essentially is going to cut production by between 1 million and 1.2 million barrels a day. What does that essentially mean? It means there's going to be less production coming out, going into the rest of the world, and that means prices for oil are going to go up. And I ultimately think the reason that Saudis are doing this is because our current president had a little tiff going with a back and forth, kind of a name-calling session a while back. And the Saudis basically obviously make a lot more money when oil prices are up, and it really snubs our current administration. So that's the fact. We shouldn't have to rely on Saudi oil, but we do because of a bad policy administration. But maybe one day we'll have a new administration and we'll go back to energy independence. But with that said, let's talk a little bit about CO2 emissions in general. I got a couple of charts I want to show you today. What's interesting about CO2 emissions is clearly over the last 20 years, the U.S. has been working really hard. Naturally, this is before the Biden administration, bringing down CO2 emissions based upon our size of our economy and the usage in general. If you look at that chart, the countries, which about 80% of countries around the world are really underdeveloped or developing, generally speaking. They're not developed like the U.S. or like Europe. The countries, 80% of these countries are the big polluters in the world, and their numbers are essentially skyrocketing up. So are they worried about global warming? No. Are they worried about cutting CO2 emissions? Absolutely not. If you look at these charts, what's interesting is you can clearly see that China is going to do whatever China needs to do in order to grow their economy. And of course, we're doing the exact opposite. We're doing things like not being energy independent, not providing good jobs or cheap energy. That's clean, by the way, and we're doing a great job making these things cleaner in the current administration. Again, I talk about the pendulum. The pendulum often swings too far one direction, and then we'll come back. Eventually, we're going to see energy independence again in the U.S. under a different administration. We'll see cheaper energy prices down the road. I firmly believe that. But for now, we're going to continue to own oil and gas assets, as we feel these are great opportunities for our client portfolios and for future returns. And by the way, energy is a great inflation hedge, much better than gold. As I stated earlier, the quarter ended well. We see greener pastures as we continue through 2023. Again, we will have volatility. Never be complacent. Never assume every single year is going to be up 20 or 30%, because you're going to have years like a 2022 that were actually down. Not as much as the market was, or not as much as a lot of investments. In fact, I talked about this today with a couple of clients on a client review. And I talked about, if you look at 2022, 80% of the market was down 40 to 80, 90% in value. Not all the market was down that much. If you look at the broad indexes and stocks that weren't grossly overvalued, generally speaking, most of those were down 18 to 20%. So again, it pays to buy quality at a value price. What I'm saying is we don't chase hot stocks that are trading at these crazy multiples, because these are the stocks you'll get burned on. If you look at the economy, whether it's bonds, gold, oil, equities, if you buy quality assets at a reasonable price that have a catalyst to do better in the future, you've got potentially a winning strategy in that portfolio, and that's what we do every single day. We're spending a lot of time on research. We're spending more money than we've ever spent on research, but that's our job. Keep a level head, keep the emotion out, invest for the long term. And again, all of our clients are long-term investors. Long-term to us is 3 years or longer. We don't have any clients that are going to spend all of their money in 3 years. You're going to spend little pieces of it. So the majority of your portfolio will be around to grow for the next 3 years, the 3 years after that, and so on. If you're, of course, have any questions about your portfolio, any concerns, please call the office. Schedule a phone review or in-office review, whatever is best for you. We want to make sure we keep you up to date on your portfolio and keep you well communicated too. And as always, we appreciate your business, your trust, and your referrals. Keep us in mind when talking to other friends or business associates as our business grows from quality clients just like you. Have a safe and profitable day.